Thank you all for joining us today for our annual year-end seminar. Before we begin, I just have a couple quick housekeeping items to go over. Today's seminar is eligible for 2 CPE credits. In order to receive those credits, you must be active for the full duration of the seminar, which is scheduled to end around 3:45 this afternoon. We will be sharing 3 polling questions per credit hour, or 6 polling questions total, which will appear unannounced on your screen throughout the presentation. You must answer all 6 of these polling questions in order to receive the CPE credits. Each polling question will only be up on your screen for approximately 30 seconds. While the polling question is up, you won't be able to see the PowerPoint presentation, but rest assured that the slides will come back on your screen as soon as the polling question is closed. If you have any issues submitting an answer to a polling question, please just send a chat to me, Kayla Juba, with your answer. Everyone is muted, so please use the chat box on your screen to submit any questions. We will answer questions at the end of each section and then have a final Q&A session at the end, so please feel free to submit questions as you have them. You can download PDF files of the booklet and the PowerPoint slides through the GoToWebinar panel on your screen under Handouts. We will also be sending out a link to access the booklet, PowerPoint slides, and a recording of this seminar on our website early next week. So thanks again for joining us. I will now turn things over to Joe to introduce our presenters and agenda.
Thank you, Kayla. Welcome everybody to the Brown Plus 2024 year-end payroll and information reporting seminar. Looking forward to spending the next couple of hours with you to give you some important information on 2024 payroll and information reporting updates that should help you as we're coming up on year end. We got it broken into 2 parts. We will present to you here for about 1 hour and 15 minutes, then we'll take a 10-minute break and then come back and finish off the webinar, as Kayla was saying, until about 3:45 this afternoon. Presenting with me this year, I have Abbie Cawood and Karen MacDonald, associates from our small business accounting services area. So they'll present on various payroll reporting topics. I'll be presenting on fringe benefits, and in the second half, we have Susan Yohn with us to give us an update on what's happening in the HR world, and Sherry Cracium-Bolin will wrap it up with information returns. So that's what we have planned for you this afternoon, and I will turn it over to Karen and she'll get us started.
Good afternoon. I'm going to share a little bit about sick pay. We are looking at specifically disability sick pay. The first thing that you need to determine is if it's taxable, and that is determined by when the pay is made. If it is made within 6 months of the disability event, it can be taxable to the employee. If it's after that 6 months, it is not taxable income. So the way you determine whether or not it is taxable income is based on who pays the premiums for the sick pay. So if the employer pays the premiums, it is considered taxable wages to the employee. If the employee pays the entire premiums as an after-tax deduction, it is not taxable to them as income. If the employee pays the premiums as a pre-tax contribution, then it is taxable to the employee. When the payments are made by the third party will withhold any applicable taxes, typically just the FICA taxes, and they will remit them. And they will include them on a 941 return And then they will utilize line 8 on the 941 return to subtract the employer FICA tax. The employer then has the obligation to match those FICA taxes. So they have to record the taxable wages and then subtract on line 8 of the 941 return the taxes that the third party paid from the employee's payout. The other thing that you have to consider is who is going to issue the W-2. So if the third party payer issues the W-2 separately to the employee for just those third party sick wages, then the employer has to file an 8922 form that is the third party sick pay recap that allows them to reconcile their 941 returns to the W-2 and W-3 forms that they submit to IRS. If, however, the employer includes those wages on the W-2, then the third-party insurance company is obligated to file a Form 8922 to reconcile their returns. So it's important that you understand with your insurance company what they are filing, what they are doing, determining whether or not the wages are taxable, to know how you need to handle it. So now we're going to turn it over to Abbie Cawood, and she's going to continue on some more information for us.
Thank you, Karen. Good afternoon, everyone. I'm going to touch base a little bit on the Form W-4. We have not made any significant changes this year or coming up in 2025. So you can continue to use the newest form, but there are no significant changes like there were in 2020. If the employee would ask you how to complete the W-4, you can direct them to the IRS withholding estimator. It is linked here on our PowerPoint and as well in the booklet, and that will help them with what they need to do to figure out their federal withholding based off of their unique situation that they have. So that's where I would guide them. And employees do not need to fill out a new W-4 every year. So even if it's before 2020, you can continue to use that form. If they have any updates, you can give them a new form, but that form, whatever year you have, is good enough to continue on their records. The I-9, it changed last year and it has stayed the same. It does have a new expiration date, so make sure you have the newest form when you provide it to your employees. That expiration date is May 31st, 2027. It was released August 1st, 2023, and there are some changes if you've noticed it. They have replaced alien now with non-citizen. It's now formatted to be completed on tablets and mobile phones in Adobe, so you can pre-fill that out now in a PDF format. It has reduced section 1 and 2, so everything fits neatly on one page for that. And you can, as an employer, enroll in E-Verify, and you can remotely examine employee I-9s to make sure that everything lines up. And then we also recommend that you maintain all employees' I-9s separately from their other employee files, personnel files. That way, in the event of an audit for I-9s, you can just provide them with a binder with all of that information. You're not exposing yourself to anything else. And now I'm going to hop over onto the Form 945, which is reporting all non-withholding tax, income tax. These payments are typically for retirement plan distributions and backup withholding from 1099s. I also want to note that compensation paid to H-2A visa holders, which are also known as foreign agricultural employees, they are typically reported on a W-2 in Form 943. However, if you run into an H-2 visa worker who does not have a Social Security number or an ITIN immediately, that employee is subject to backup withholding. And the wages then should be reported on a 1099 miss, not the 1099 NEC, because then you will use the miss and the 945 to report that back up withholding. So I just want to point that out in case you have any of those employees and how that really should be reported. And then the federal withholding that you're collecting from this is paid into EFTPS just like you would your federal other income taxes such as 941 and 940. You'll just select the 945 as the form name and the year through EFTPS, and you can just make your payments that way. For years that you do not have any federal income tax non-payroll withholding, you do not need to file a form 945 even if you have in the past. That's not necessary. And this is an annual form and it is due the end of January, just like your other payroll forms. However, if you paid all your payroll tax deposits timely, the IRS does give you a small reprieve, and that would now be due February 10th of 2025 for the 945 return for 2024. And then just explaining the deposit rules with that federal income tax withholding. They are very similar to your payroll tax deposits. So the monthly depositor is $50,000 or less for your look back period. The semi-weekly depositor is greater than $50,000, and just like payroll taxes, if you have a one-day deposit rule for $100,000 or more that you need to get that paid in. And you can determine the look back period by using the second calendar year preceding the current calendar year. So for example, 2025's look back period will be 2023. And then the penalties for untimely payments are very similar to payroll tax deposit rules as well. I also want to make a note just about Pennsylvania, even though we're on federal, that they do require withholding of 3.07% for non-wage PA income source payments if you have a non-resident and you are paying them over $5,000 or more for the calendar year. And then PA does suggest, if you aren't sure if you're going to hit that $5,000, that you should do the withholding anyways and pay that in. So if this is the first year you're doing this, you can pay that in by registering a PA 100 through MyPath. And you can also use that account number then to file your 1099s. And I know Sherry will touch on this a little bit later, but PA is requiring, if you have 10 or more, that they need to be filed electronically. And you do need a withholding account number for that, either the employer withholding account number or the non-payroll withholding ID. So make sure then that you register for that PA 100. And now I will jump over and talk specifically about some Pennsylvania rules regarding payroll. As you can see here, nothing has changed except Social Security for 2025, and that is the increase of $176.10. It was $168.6 in 2024, so it continues to go up every year. The results in the increase in tax will be $465 for an employee and an additional $465 for employer if that employee is reaching that limit. And then I also want to touch on PA does not have a credit reduction due with the 2024 940 return again this year, so you don't have to worry about any additional tax if you have been paying that in quarterly. California, Connecticut, and New York are subject to a credit reduction of 0.9% for 2024, so just be aware if you have any employees in that state or that you need to report that you will need to add that on your 940. And just also another note, I know it's been a year now, but PA unemployment for the employee is still at that 0.07% instead of 0.06. Pennsylvania new hire reporting continues to be due 20 days after the hiring date. So make sure for any newly hired and rehired employees that you are reporting. You can follow the link here. to file them. I know they encourage that to be done online. And what this does is it helps the state to cross-match open court cases for child support, locate non-custodial parents who change jobs frequently, and reduce fraudulent overpayments in state benefit programs such as unemployment and workers' compensation. So I know employers have asked me in the past, why do I need to do this? This is good due diligence. We don't want anybody double dipping, and then it helps you get any child court custodies, anything that you need that you know that you need to have a court order employee requirements met. And the employee report, PA employers would report all employees who reside or work in PA to the PA new hire reporting. So hopefully that gives you some clarification, even if you have other employees in other states. If they are working in PA, you do report to Pennsylvania. The electronic funds transfer for Pennsylvania. All state payments of $1,000 or more need to be paid electronically, and this can be done through MyPath. Approved payment methods are ACH debit, ACH credit, certified and cashier's checks that can be hand delivered if you ever desire to drive up to Harrisburg and stop in the Pennsylvania Department of Revenue's office. But as you know, MyPath is very smooth with this transition. You can set up separate bank accounts based off of different accounts that you have set up in there. So feel free to set that up with those payment channels. There is a 3% penalty assessed with a maximum of $500 for non-compliance. So make sure any payment over $1,000, even if that's just a 501 payment, it needs to be done electronically. The mandatory electronic payment threshold for $500 is if the total liability owed equals or exceeds $5,000 per payment period. And just a caveat to that, even if you only hit that once, that you then have met that threshold, and all subsequent payments, even if they're less than that amount, need to be remitted electronically. Failure to comply with this would be a result in a 10% penalty based on the face value of the payment of a maximum $500. So it is pretty steep. So make sure, we definitely advise all our clients to make payments electronically. You don't want to be trusting the post office to get your stuff there on time. That's definitely the most efficient way to do that. And payments for unemployment can continue to be made through the UCMS website. Feel like it's that time of year again that you're probably looking at any uncleared checks and trying to clean that stuff up. So writing dormant accounts off into income does not negate the obligation to report and deliver unclaimed property. So all reports now should be done electronically for Pennsylvania. The holder record keeping system was updated in 2021. So if it's been a few years since you've logged in to use that, I recommend that you check it out, because you will need to register for a new account login. Under that system, your old login will no longer work. And you can also request early remittance, but the property still must be at least 1 year old. So if you need to clean stuff up and you don't want to wait the 2 to 3 years, then you can request an early remittance. We also recommend direct deposit. That helps you make sure everybody is getting paid and you don't have to be chasing after some of those employees that lose some paychecks every now and then. We will now hand this over to Karen so she can explain to you all of the Maryland payroll laws.
The screen you're seeing now is very similar to the one that you viewed for Pennsylvania, and the only change for Maryland as well is the change in the Social Security wage limit, going from $168,600 in 24 to $176,100 in 2025. I did want to highlight Maryland unemployment. They did update a new website to a new website a few years ago, the Beacon website, and that is the website where you will go to do all of your filing and submit your payments. It is also where you will go to find the new rates for the new calendar year. They normally post those rates sometime in January, and you would need to log on to your Beacon website to check for your new rate under the correspondence section. And then that's what you would enter in your system or accrue however you handle your unemployment tax. The taxable wages are still $8,500. And on the website, as I said, that is where you will file the return. The payment, they do have an option to print a paper voucher and mail in a check. But as Abbie said, the direct debit is always a much safer option, and you know they have it. And you can post date the payment to the end of the quarter when it's actually due. It's just a much better option, and definitely what we would recommend for you. The state of Maryland has taxes for the state. There's a portion of the Maryland withholding, which is the state's portion, and then the counties set their individual rates each year. The 2025 county and local rates have not been published yet, but they should be published sometime in the month of December. And you can find that on the Comptroller of Maryland's website. If you look for withholding tax facts, we have a link on here. When you search for that tax facts, you just have to find the proper year. And as I said, sometime in December, they should have those rates published. They have remained fairly steady for the past few years. The only unusual change that I have seen is in 2024, Anne Arundel and Frederick counties now have a sliding income tax rate, which is based on the taxable income. It's not a large difference, but they do have several different rates. So you would want to look at those tax facts to get the actual information. For electronic funds transfer and filing the sales tax returns and withholding returns, they changed the website from the B-File website in January 2024 to a new website called Maryland Tax Connect. It was introduced in February of 2024. Had a bit of a rough start, but it is pretty consistent now. The old B-File website is still available that you can log into if you need to view or download copies of any of the returns that you filed on that website. You can do that, but you cannot file any new withholding or sales and use tax returns. The B-File website will also be used for 2024 W-2 e-filing. So the new website, as I said, it was introduced in February of 2024, and it is currently being used for employer withholding returns and payments, and then the sales and use tax returns and payments. It can also be used for applying for new accounts for employer withholding and sales and use tax. They do plan to be using this website in the future for other business tax payments as well as personal tax payments. So at some point, any Maryland employers or Maryland businesses will most likely become familiar with this website. I also wanted to mention, if you have any issues with your registration or with returns, if you go to the Maryland Tax Connect website, they do have an option to schedule a callback appointment, usually in the following week. And that does work. I've used it a few times. They will call you back and they will assist you with whatever issues you are having. As in Pennsylvania, Maryland does have a new hire reporting requirement. And same as Pennsylvania, it needs to be done with within 20 days of hiring a new employee or rehiring an employee. And the state of Maryland has two options, although they highly recommend using the website. They do allow you to fill out a paper form and then fax that in to the phone number on this link. In September of 22, Maryland State introduced the Maryland Saves program. This is a retirement savings program for employees for when an employer does not have a traditional simple IRA, 401k, 403b, SEP plan. If the employer doesn't offer another retirement plan, the state of Maryland wanted an option for employees for savings and for, in particular, retirement savings. The deductions that come off of the employee's checks are treated as post-tax. They are considered a Roth IRA deduction. They will show up on the W-2, but they are not a pre-tax deduction. There is no cost to employers for administration, and there's no cost for an employer match or anything else. So it is just a way of the state offering to employees who don't have another option to save for their retirement. The plan, as an incentive to get employers to sign up, they do offer a waiver of the Maryland personal property filing fee of $300. So if you are signed up as an employer and have a Maryland Saves program login, you will automatically receive that waiver. If you have your own employer-sponsored retirement plan, you can go to their website and certify your exemption and receive that waiver. But that exemption and that certification has to be done each year. They also have an option for employers who do not have an automated payroll. So if you process your payroll by hand, perhaps you just have an officer payroll, or it's a very small system and you just do things by hand. They do offer an exemption for that, which would also waive the Maryland personal property tax filing fee. You have to go to their website and apply for that waiver, and you will need the access code that Maryland Saves sent out when they first introduced the program. If you did not receive an access code or you cannot locate it, you can call their office and they will provide that for you. So a new program that Maryland is in the process of introducing is the Maryland Paid Family and Medical Leave, called FAMLY for short. This was in response to a need for employees to have another option for paid sick leave that was not the responsibility of the employer. 10 states currently have a paid leave program for employees, and 4 more, including the state of Maryland, are in the process of setting one up. In Maryland, in November, just earlier this month, they published their proposed regulations, and they are not marked as final yet, but they have a pretty good start for the regulations. Their plan is that in the spring of 2025, all employers, all Maryland employers, must register with the state on the family website. And this will ensure that all the reporting for all Maryland employees employers will be done on their website. The other significant dates are that then the deductions from the employee's pay as well as employer contributions are to begin accruing on July 1st, 2025. And then the returns and the contributions will be due to the family program on October 31st, 25. They will be quarterly returns that will be filed similar to other payroll tax returns, and then the payments made to family each quarter. And then the benefits for the sick pay to be available to employees is set to begin July 1st of 2026. So the guidelines for this program is that there is this state plan that they are offering. They are also mentioning that there is an option for private plans, whether that being self-insured or using a commercial insurance company. But employers who want to go with a private plan must seek approval with the Maryland Paid Family and Medical Leave program before they actually assume that they're okay to do that. So those private plans are going to be approved sometime before they're actually, the benefits begin, but they don't have a definitive date just yet on that. The taxable wages, they decided to make it easy on employers, and the definition for taxable wages is exactly the same as Maryland unemployment wages. So if you file a quarterly Maryland unemployment return and employee has $10,000 of wages, that's what you will report on the Maryland family tax return. And I also wanted to mention that there are no employer exemptions except for the federal government. So if you are a nonprofit or a religious organization or any other type of organization that you feel should be exempt, you are not. So then I want to talk a little bit about those contribution guidelines. So the state plan is the deduction total contribution amount is 0.90% of covered wages, and it's divided equally between the employee and the employer. So the employee portion that's going to deduct from their paycheck is 0.45%. And I did want to mention, I don't have it on my slide here, but the taxable wage base for this is to be set as the same as the Social Security wage limit. So it doesn't end like Maryland unemployment at $8,500 of taxable wages. It goes the whole way to the Social Security wage limit based on the guidelines that they have right now. They are saying that employers may choose to cover part or all of their employees' contributions. So while it is said that the employee contribution is 0.45%, an employer can choose to make the entire 0.90% contribution themselves. They do have a little reprieve for smaller employees. So if you have 14 or fewer employees, you are not required to contribute the 0.45%, but you are still required, even if you only have one employee and the employee is an officer, you still have to collect and remit the employee portion of 0.45%. They are also offering an opt-in for self-employed individuals, and those individuals would pay the entire 0.90%. I'll talk a little bit about the benefits, although they are not as set in stone, and I think Susan's going to talk a little bit more about that when we get to the HR section from the employer side. But it is based on the FMLA in terms of qualifying events. So if someone is out for an extended medical leave, or if they have someone who is departing for armed services, there's an exemption for that. If you're out on a pregnancy leave, this is going to be able to provide that as well. And it can also, they did mention that if an employer provides sick pay, that sick pay can be used to top off the family benefit, because the family benefit has a cap at, I believe it's $1,000 a week. And so if an employee typically receives more than that, they can use their employer benefit to get up to their normal wage. There is up-to-date information on the website, which I have here on this slide. And the other thing that they are doing is they are providing monthly webinars on the plan and the program, allowing for question and answers. So if you want more information, I suggest you sign up for a webinar and sign up for the email updates that they are also providing. And then the last thing I'm going to talk about is the unclaimed property laws in the state of Maryland. As Pennsylvania, there is a law that if you have property which is deemed unclaimed, that after 3 years, those uncashed checks, whether they be payroll or vendor checks, are considered abandoned property. You have to send notice to the recipient at their last known address between 30 and 120 days prior to turning those funds over to the state of Maryland. And then if you do not receive a response, they are to be reported and the funds transferred to the state. They do have paper form options, which we have copies in the back of the booklet. The ST918 and the ST919, but those paper forms can only be used if you have less than 10 items to turn over to the state. So if you have more than 10 items, you have to use the link on this website on the screen to submit those items to the state. I think that's all I have. So I'll turn it over to Joe.
Okay, great. Thank you, Karen. Thank you, Abby. Be sure to get your questions in through the chat if you have questions on anything that Abby and Karen were presenting on. I'm starting the next part of the webinar on page 20 to talk about COBRA. And what we're talking about here is an obligation for employers who are providing group healthcare plans, an obligation to provide continuation coverage for employees or their spouse and dependents when they cease to be participants in your plan. There is a model notice of rights that we put into the materials. If this is something that you're hearing for the first time, that model notice of rights is on page 139. You as the employer are required to provide your participants with the model notice of rights when they become active participants in your plan. And what that is doing is setting the guidelines for who's going to notify the plan administrator when there's a change in an employee's status. So what that affects is there's 5 criteria: death of the covered employee, termination of the covered employee. The covered employee may become eligible for Social Security and Medicare benefits, bankruptcy, or a where a dependent ceases to be a dependent. So you as the employer will know 3 of those 5. 2 of those you may not be aware of. And that's in situations where you have a divorce or legal separation, and when dependents cease to be dependents in the plan. That would be the participant who needs to notify the plan administrator. Who do these rules apply to? They apply to employers with more than 20 employees. There are exemptions for small plans. That would be the under 20 employee providers, governmental plans, and church plans. Pennsylvania does have a mini COBRA requirement. So for employers that have group plans and under 20 employees, you are covered under these rules on a smaller scale, but Pennsylvania does require participation in some form of a continuation coverage plan. There are penalties for failure to comply with these rules. Those penalties are $100 a day. For each qualified beneficiary, it's capped at $200 a day. And the penalty can be assessed for a period of up to 6 months after the continuation coverage period. So the coverage period typically runs 18 months, but it can go up to 36 months in certain circumstances. So these penalties can become onerous if you're not in compliance. And you as the employer could be required to correct the failure. So if there is an individual who should have been offered coverage but was not, and had a catastrophic medical expense, you could be obligated to cover that. Again, just looking through some definitions here. Who does it apply to? Qualified beneficiaries, that's the spouse and dependents and the covered employee. If they are terminated or fall out of the plan because of a reduction in hours. What are the qualifying events? Termination or reduction of hours, divorce or legal separation, dependents ceasing to be dependents, death of the covered employee, bankruptcy, or the employee becomes eligible for Medicare. So you as the employer will know several of those. The risk is with the 2 areas where you may not be getting information on a timely basis, divorce or legal separation, and when dependent children cease to be dependents. Moving on from COBRA, we'll get into the taxation of fringe benefits. So as we're presenting this information to you here on November 21st, we are looking at picking up the taxable portion of fringe benefits and getting those into the employee's pay before the end of the year. So, you know, fringe benefits come in many different forms. What you have to keep in mind that generally fringe benefits are taxable, and if taxable, they're subject to Social Security and Medicare withholding. They're subject to federal withholding, and you have to be aware of that. There is a supplemental withholding rate for fringe benefits at a rate of 22% if you're not sure how much you should be withholding. You as the employer can elect to just include the fringe benefits in one of your pay periods and let the payroll tables determine how much is going to be withheld. You as the employer have options when it comes to when you're going to include the fringe benefit in compensation. You could do it weekly, monthly, quarterly, but at a minimum, you have to do it annually. So as we're coming up on year end, you need to be looking at those sooner than later. There are exclusions for certain fringe benefits under Code Section 132 for de minimis benefits, employee discounts, no additional cost services that your employees may be getting a benefit from, and working condition fringe benefits. So if you cannot find an exclusion for your fringe benefits under one of these 4 exceptions, then you're looking at a taxable fringe benefit. There are fringe benefits that are excluded from the employee's compensation, but they are excluded under other code sections, not necessarily under the 132 code section. Accident and health benefits are not taxable. Achievement awards up to a certain amount can be excluded. Dependent care assistance, group term life insurance, at least the first 50,000 of group term can be excluded. And if you have an educational assistance program, that can be excluded as well. So you have to know what the fringe benefits are and what the tax consequences would be. So if you find yourself with a taxable fringe benefit, you have to pick up the taxable portion and get it into the employee's pay before the end of the year. A lot of employers have business expense reimbursement plans. What we have on the screen for you right now is how to make certain that your business expense reimbursements will be tax-free to the recipient and tax deductible to the employer, which is a win-win proposition for the employer. So how do we make sure that our business expense reimbursement plans come under the appropriate method to exclude those? You need to have an accountable plan in place, and an accountable plan really is just to have a process in place for reimbursing business expenses. So at a minimum, the government requires that you have a plan where you provide the business connection. I shouldn't say you as the employer, the employee provides the employer with the business connection, substantiation for the dollar amount that they are looking to be reimbursed. If they got an advance, they will return the excess amount of that advance if they didn't spend it all. There is the ability for an employer to use a per diem or a mileage rate based on federal rates. If you're doing that, that's deemed substantiated, but you still have to get the business connection in order to make that reimbursement tax-free. Back one. So again, with an accountable plan, you're looking for certain information when the employee submits for the reimbursement. If you're getting that, it's tax-free to the employee and you don't have to report it on the W-2 or on that's taxable pay. On this page, in 27 and 28 in your booklets, we go through what are the various taxation of these reimbursed amounts. If you meet the accountable plan rules, if you don't have an accountable plan, by definition, you have a non-accountable plan, and any reimbursements to an employee are taxable regardless of the amount. We do have on page 29 in the booklet, if you're not sure if you have an accountable plan or not, just copy this page out of the booklet, hand it out to your employees, and let them know that if they're submitting requests for reimbursement of business expenses, this is the information that you're looking for. In addition to business expenses, there are limitations on certain business expense deductions. Business meals are subject to a 50% limitation. That was put on hold temporarily for a couple of years post-COVID, but beginning in 23, that 50% disallowance has been put back in current law. Entertainment expenses are non-deductible, and travel expenses for dependents are non-deductible unless included in compensation. Moving expenses and certain employee achievement awards could be in that limitation as well. Group term life insurance, the value of group term life insurance, the first $50,000 is a tax-free fringe benefit. There is an exception to that rule for S corporations and 2% or greater shareholder employees. For that group, the group term life insurance is a taxable fringe benefit. And we'll talk a little bit more about that later in our slide deck. But at the moment, what we're talking about is group term life insurance for employees that are not shareholders of an S corporation. So first 50,000 is tax-free. Anything over 50,000 is a taxable benefit. So if you are providing a group term life insurance program, and you do have employees that are getting an amount of insurance in excess of 50,000, you have to value that taxable fringe benefit using the uniform premium table. So we have that in your booklet on page 30 and 31. Under the table, you're going to determine the taxable fringe benefit based on the age of the participant in the program. So what you have to keep in mind with this table, it's a monthly benefit calculator, not an annual benefit. So when you determine if you have a participant that's getting in excess of 50,000 of group term life insurance, you have to calculate the fringe benefit from this table. Keep in mind that once you determine it, it's just 1 month of taxable benefit. You'll multiply it by the number of months the individual participated in the plan. So if they were in the plan for the full year, you're going to multiply it by 12. So that is a taxable fringe benefit that you need to be calculating here before the end of the year. Another common taxable fringe benefit is personal use of company provided vehicles. So a lot of employers do provide company vehicles to their employees, and the expectation would be that there is a taxable fringe benefit for the personal use of that vehicle. There are exceptions to taxing personal use. There are 4 exceptions that well, 3 if you're not an auto dealership, 3 areas where you can exclude the personal use. If it's a working condition fringe benefit, meaning it's not personal use, it's business use. Where this might come into play is you, the employer, might have a plan that the employees can only use the vehicles for business use. The vehicles stay at the business premises overnight, and employees just use it during the working day. That's a working condition fringe benefit. It doesn't provide for personal use. De minimis personal use. In the example I was just talking about, if the employee uses the vehicle to run personal errands to the post office, out for lunch, or to a doctor's appointment or something like that, that would be considered de minimis. And then qualified non-personal use vehicles, that's construction type vehicles or vehicles where the employer has equipment in those vehicles that the employees use on a day-to-day basis. So those vehicles don't lend themselves to personal use for the most part. So you could get an exception even though your employees are using them and taking them home overnight. If you don't qualify for one of the exceptions to a tax-free fringe benefit, then you have a taxable fringe benefit for personal use. You have two options here. You can use what's called the general valuation method, where you as the employer determine what the cost of operating a vehicle is for the year. And then based on the personal use percentage, that's the amount you would include in an employee's payroll. If you don't want to do the general method, you've got three choices under what's called safe harbor methods: commuting method, cents per mile, annual lease value. Under these three methods, the simplest one and the one that's going to give you the lowest personal use value would be the commuting method. That's $1.50 per one-way commute, $3 a day. What you have to keep in mind with that, you as the employer have to have a written policy that prohibits personal use. It only allows commuting. Also keep in mind that if it's a control employee that's using the vehicle, you cannot use the commuting method, even though that's your policy. The second option would be cents per mile. Again, a relatively easy method. This is personal miles multiplied by the standard mileage rate published by the government. Currently, that rate is 67 cents per mile if you are paying for fuel for the vehicle. If not, you can reduce the 67 cents by 5.5 cents. So that would be 61.5 cents for valuing personal use under this method. Keep in mind that if the fair market value of the vehicle is in excess of $62,000, you cannot use this method. You'd be forced then to the third method, which is the lease value method. This method takes the fair market value of the vehicle and determines the personal use amount from a table provided by the government, the annual lease value table, which is on page 40 in your handout materials. From this information, you can determine personal use based on the percentage of personal to total miles that the employee is documenting for you. If you are using this method, you have to use the same fair market value for 4 years before you can revalue that vehicle for the individual that's using the car. From a record keeping standpoint, again, it's the employee who has to maintain the appropriate logs for the vehicle to provide you with business and personal use. We do have for you in the handout materials data collection forms that you can use to hand out to your employees that will allow you to capture the data to determine how much this fringe benefit is for that employee. Starting on page 133, we have the employee representation form. So you would hand this form out to your employees. They're going to tell you a lot of information here. You know, what are personal miles, what are business miles, if they're commuting, how many round trip commutes, if gas is provided, or if they're paying for the gas. So from this information, you will then have enough information to calculate the personal use using the other forms we have in that section that allow you to calculate the personal use under any of the three methods that we had talked about, whether it's the annual lease value method or the commuting method or the standard mileage rate, the cents per mile. So, so we do encourage you to use these forms, hand them out to your employees, and make sure you get them back in a timely manner so that you can get this fringe benefit included in your payroll before the end of the year. For the S Corp employers that are participating today, you do have to be careful with your 2% or greater shareholder employees, because a lot of the fringe benefits that are not taxable to your employees that are not owners will be taxable to the S Corp 2% or greater shareholder employees. And in cases where these benefits are taxable, you are looking for the actual premium amounts for these benefits. You're not using the group term, or excuse me, the group term life insurance table. You're going to use the actual premium that you're paying for that benefit for those individuals. So what benefits are taxable? It's the accident and health, that's your health insurance, group term life insurance, regardless of the dollar amount, disability insurance. A lot of employers now are going to health savings accounts. Those health savings accounts would be included in this taxable amount, and workers' compensation premium. Also keep in mind that the taxation of these benefits for this group of individuals is a federal taxable benefit. Pennsylvania does not tax those benefits, so they're non-taxable for state tax purposes. As we're coming up on the end of the year and we're calculating these fringe benefits, you have to get them into the employee's compensation before the end of the year. When you're including these fringe benefits, they are subject to withholding tax, could be subject to Social Security and Medicare withholding as well. And depending on the type of benefit, could have state and local tax in addition to federal. So it's going to reduce the individual's net take-home pay in the period that you're including that benefit in their pay. So on page 34 in the booklet, we're providing you with a formula of how you can gross up that fringe benefit if you do not want to reduce the net take-home pay for the individual in the period that you're including the fringe benefit. Keep in mind with the gross up, it is the employer who's taking on an additional amount for that fringe benefit and is going to pay more for it than they would if they didn't gross it up. So in our example, we are picking up a $2,500 fringe benefit. And this is for an example of a Pennsylvania resident employee. Once we total up all of the federal and state withholding percentages, it adds up to 33.78%. We subtract that from 100% divided into the $2,500 benefit that we're providing, and it grosses up that benefit to $3,775. So you as the employer would be paying an additional $1,275 in this example if you're going to gross up that benefit. So again, comes at an additional cost, to the employer to provide that benefit. So keep that in mind as you are calculating these fringe benefits as we're coming up on year end. From a year-end preparation standpoint, again, you're going to want to determine the amount of the taxable fringe benefits. Again, the earlier the better, no later than December 15th. Gross up those fringe benefits if necessary. You do have to deposit your payroll taxes in the period that you're including those in pay. So you have the deposit requirements for that pay period that you are including them. Update your payroll records. If you're using outside service bureaus, you have to notify them what's happening. And you have to get those fringe benefits into W-2s and reconcile your 941s as well. So again, best practices as we're coming up on year end. On pages 49 and 50, we do have a comprehensive example for you, showing you how to get these fringe benefits into payroll, and also a copy of a 2024 W-2 and where the various numbers go. So the example we have for you on page 49, we are showing you, what a typical biweekly pay is for the employee that we are providing an example of for here. We are picking up 2 taxable fringe benefits. We have personal use of an automobile, and we have group term life insurance in excess of $50,000. So when you put those into an individual's pay, when it takes out the various withholding and taxes and all that, you're going to get less net take-home pay. And you can see that on the screen here, what the typical net take-home pay is versus the take-home pay when you include it in payroll for that period. That's where you'd be looking at the gross up method to try and keep that reduction from occurring, and the employer is going to pay an additional amount for that fringe benefit. On the W-2 for 2024, not a whole lot has changed on the form when you're looking at 23 versus 2024. Again, areas to be mindful of as you're beginning to prepare the W-2s or review them before you issue them. Box 13 is the retirement plan participation. So if you do have a retirement plan, 401k plan, or a profit sharing plan, you need to be checking the appropriate box if your employees are participating. Box 12 is for certain information the government's looking for. That's where your 401k deferrals would be reported. Your group term life insurance benefit is in there. For large employers, we're showing you the DD, which is the health insurance benefit that you're providing to your employees if you have employer provided health insurance. Box 14 is for other information that you want to provide to your employees. We put in here the fringe benefit for the auto and the PASUI. That's really for illustration purposes. You want to put in there, like your S Corp 2% shareholder employees, put in what that taxable amount is. You want to disclose that in box 14. Provide the employees really with any relevant information that's included in their taxable wage amount on line 1 that they might be able to take advantage of on their personal income tax returns. On the Pennsylvania resident employees, for state wages and local wages, generally those 2 boxes should equal one another. So as you're reviewing those W-2s, look for those boxes to again have the same amount taxable wage for Pennsylvania and local purposes. On the Maryland side, I think Maryland allows the or does not tax the 401k deferrals. So box 1 federal wage is typically the same amount on the Maryland state wage line. At this point, we'll check with Kayla here to see if we have any questions from participants at this time, and if we do, we'll answer these. Kayla, what do we have?
We do not have any questions as of right now.
Okay, so we don't have any questions, and we've hit the spot in our presentation where we're going to take a 10-minute break. So Kayla will put us on a 10-minute break here, and when we return, we'll take on the second part of our presentation.
Hello and welcome back to the webinar. I'm Susan Yohn. I'm the Director of HR with Brown Plus. I have been in HR for almost 18 years and have been with Brown Plus for 13 years, leading the internal HR department as well as our HR consulting services. I'm going to go over a HR update today. Some things that are a little bit outside of the tax department and payroll taxes, but hopefully you find the information useful. Just a disclaimer before we get started, this is for general purpose. I'm not an attorney, an employment law practice attorney, and every employer situation is different. So please keep that in mind as we're going through this. Our agenda for today is to discuss the Fair Labor Standards Act, the overtime rule, minimum wage, pay transparency laws, Pregnant Workers Fairness Act, the Maryland Paid Family and Medical Leave Insurance that Karen spoke about earlier. I'm going to touch on that from an employer standpoint, and also mention the Crown Act. There's going to be a lot of material that's going to be covered in a high level, and feel free to ask questions in the chat as we go along. I'm going to get started with the Fair Labor Standards Act. We're going to look at the background, who's a covered employer, and some of the exemptions. And if anybody follows this, like I do, there's been some exciting things happening, if you can call them exciting, with the Fair Labor Standards Act and the overtime salary threshold rule. So looking at the background, the Fair Labor Standards Act was established to set up standards for minimum wage, overtime pay, record keeping, and child labor. There are many states, though, that have a greater benefit to the employee as it relates to minimum wage and overtime exemptions, and the salary threshold. So we'll take a look at that here in a second. So if you are an organization with 2 or more employees and an annual dollar volume of sales or business of at least $500,000, you are covered under the Fair Labor Standards Act. And if you are also engaged in interstate commerce, this includes private companies, government agencies, schools, nonprofits, etc. Under the Fair Labor Standards Act, it stipulates that employees must receive pay for hours worked in excess of 40 hours in a work week at a rate not less than 1.5 times their regular pay, unless they fall into one of the exemptions. In order to be exempt from overtime, there are 3 requirements that have to be met. The employee must be paid on a salary basis. The employee must be paid a minimum weekly salary based on the salary threshold. And they also must meet the job duties test for an exemption and fit into one of the job duties exemptions. You cannot have 1 or 2 of these and have someone be exempt. All 3 of them must be satisfied in order for an employee to be considered exempt, and therefore they do not need to receive overtime pay. Looking at some of the duties tests, 5 of the most common federal's job duties exemptions are executive. This is for anyone in a management position who has the authority to hire or terminate employees. Administrative, if you are an office employee and you work directly related to any business operations. Professional exemption would include a learned professional, anyone with an advanced degree or knowledge. Computer employees are anyone in computer or IT field. And outside sales, as opposed to inside sales, sales that are away from the employer's place of business. One thing that's important to note is while these are federal exemptions, in PA, we do not recognize executive and computer employee exemptions. So if you have gone through and looked at your employees and made sure, done an audit to make sure they meet these requirements, and you have someone classified as exempt based on the executive or computer employee exemption job duties test, you'll want to make sure that you go back and you are able to provide different justification for their exemption under the job duties test. Maybe they would fall into a professional type exemption. So the exciting news that has been happening is around the salary threshold increases. So you can see over time how the salary thresholds have increased. Many of you may remember in 2016 when the Department of Labor was going to increase the salary threshold, and 2 weeks before it was supposed to be implemented, it was actually struck down. The courts ruled that the DOL had exceeded their authority with the level of increase, that it was too high, and also with the automatic updating feature that they had put into the law. And then in 2019, it did increase the salary threshold to almost $36,000. And then this year, there were new regulations released. One took effect in July, and that salary level went to almost $44,000, with an expected jump on January 1st to over $58,000. On Friday, however, I had to go back and change all my slides, and the court has actually overturned not just the 2025 new salary threshold, but also they went back and overturned the July 1st salary threshold. And whenever they were, prior to this final conclusion and overturn, there was 3 different court cases in Texas where employers and chambers of commerce were actually trying to overturn the regulations. So they were allowed to not follow the regulations, but it only involved those who were involved in the lawsuit. It was not a nationwide hold on the laws. So the conclusion, whenever they did overturn it on Friday, was the same as the conclusion that they came to in 2016, that the Department of Labor overstepped their authority in regards to the amount that the salary threshold had increased, and also the automatic adjustment that was supposed to happen every 3 years starting in 2027. So employers who were responsible for complying with the July 1st increase, what now? We are back to the 2019 salary threshold levels. And if you're an employer that had to comply, there was probably one of two things that you did. You either increased salaries to reach the July 1st threshold, keeping your exempt employees exempt, or you reclassified your exempt employees as non-exempt due to the salary threshold increase. If you're looking at these two options, the first one, if you increase the salaries to reach the July 1st threshold, you'll want to take a hard look at if reversing those salaries to the prior July 1st threshold requirement is going to be something that you as an employer would like to do. It might create morale issues, could lead to employee relations issues. But you also have the fact that the DOL overturned it, so that could also be used as an explaining point to team members. If you did reclassify as exempt team members as non-exempt in July, you can easily just switch them back to exempt as long as they still meet the duties test. Want to just give a note here that with any regulation change to the salary threshold or anything under the Fair Labor Standards Act, it's an opportunity for employers to look at their classifications of employees and make sure that their employees are classified correctly. It's kind of a gift where you can look at these and then tell employees that, you know, this is the reason why you're making a change. For them being exempt or non-exempt. Wrongly classified employees, if an employee were to go and file a complaint, employers are liable for all unpaid overtime as far back as 3 years, and $1,000 in penalties per violation, and they can also be criminally prosecuted, which would mean imprisonment and jail time. I've listed a couple of resources here. The federal government does provide decent documentations for the exemptions and the worksheets. So I encourage you to go there if you have any questions on the classifications of your employees. The Fair Labor Standards Act also establishes the minimum hourly wage levels. And currently, the federal minimum wage is at $7.25 per hour. There has been legislation to increase that, but nothing has passed federally. Each state varies. So there are 13 states that mirror the federal minimum wage at $7.25. There are 30 states plus DC that have a minimum wage that's higher than the federal minimum wage. And there's actually 7 states where the minimum wage is lower than the federal, but since it's lower, it defaults to the federal amount of $7.25. Wanted to point out a couple minimum wage examples. In Pennsylvania, it's $7.25 an hour. Maryland, it's $15. Regardless of your size, but there is a fluctuating rate based if you're depending on the size of employer in Montgomery and Howard counties. In New Jersey in 2024, it's $15.13, and in 2025 it does increase. So if you have multi-state employees, it's very important that you're aware of what the minimum pay wage is, and that you're complying with the guidelines. And I've also listed a nice graphic from the DOL of minimum wages and also the Maryland wage, all of that. Keeping with the theme of pay, we're going to talk about pay transparency laws. This is something that is new, but gaining speed fast. Pay transparency laws require employers to disclose information about employee compensation, either to the employees or to the public. The laws are intended to promote fairness and reduce pay disparities based on factors such as race, gender, and ethnicity. And it's important to note that it is based on where the position is located, not based on where the company is headquartered or where the employee lives. Currently, there is not a federal pay transparency regulation. Federal contractors are an exception to this, though. They have their own rules. It's important to note, too, that under the National Labor Relations Act, there is no change to protections for employees who wish to discuss their pay with others. Just because an employer is not a union employer or have union representation does not mean that they are not covered under the basic provisions under the National Labor Relations Act. And there are a growing number of state law requirements. There are currently 13 states that have current and past laws with future compliance in regards to pay transparency. And if you have any positions that are in any of these jurisdictions, you also have to comply with the pay transparency laws. They are not all the same. So if you have someone in Massachusetts, it will be different than someone that is in Nevada. So you will need to look at these based on each state. As of today, there's no laws in PA related to pay transparency, but it's also important to note here that for any employers that are in the city of Philadelphia, that it is illegal to ask a job applicant about their pay history. If you're doing this, if it's on an application, part of your interview process at any stage, you should stop doing this. A good rule of thumb, so you don't forget, is to just eliminate it from all interviews as a practice for your company. You can ask instead what the pay expectation is for the role and get the information that way. You can compare it to market data, which is also helpful and usually more reflective than looking at the pay history. In Maryland, they have equal pay for equal work, wage range transparency, which became effective on October 1st of this year. It requires that internal and external postings include the pay range, including a minimum and maximum wage, and it has to be a good faith wage. So it has to accurately reflect the position and the compensation that would be given to that position. It cannot be overly broad. A general description of benefits that would include insurance, PTO, and any other compensation such as bonuses or tips. This is important to also make sure that if you are using agencies that they are also complying. It doesn't just involve your direct postings, but all through agencies. And having a remote posting is not a safeguard for you not to include wage transparency information. And if an employee can be hired from a state with pay transparency laws, the employer must comply with the laws of that state. There is a penalty up to $300 for each employer applicant for whom the employer is not in compliance. So that can get quite costly if you have a lot of applicants for a position. So next steps, nothing in PA as of yet, but be ready, it is coming. Employers in Maryland and other jurisdictions, make sure you review the regulations for those areas. And if you are not complying, make sure you do comply. I do know that the large requisition placement sites like Indeed, that if you aren't in compliance, they will actually pull your position from their site. So want to make sure you're in compliance. And with the pay transparency, you'll want to make sure you keep record of the compliance with the law for at least 3 years after the position is filled. So more document retention policies. And I've also listed some resources here. The disclosure statement is really a nice resource for Maryland. So if you are unsure what you need to put in a job posting, it outlines what you should have in there, allows you to check box if it applies to you or not, and then you'll know what you can include in the job posting to make sure you are in compliance. Leaving the pay, I want to transition into leave and pregnancy-related topics. The Pregnant Workers Fairness Act is a federal law governed by the EEOC, and it just went into effect this June. So it is relatively new. What it does is it requires covered employers to provide reasonable accommodations to a qualified worker's known limitations related to pregnancy, childbirth, or related medical conditions unless the accommodation will cause the employer an undue hardship. That's a mouthful and really hard to understand what that means. So I wanted to kind of break that down so you can see exactly what each part of this is talking about. So you are a covered employer if you're in the private or public sector and you have 15 or more employees. And if you are a covered employer, you have to provide reasonable accommodations. Reasonable accommodations for pregnant workers could include additional breaks, longer breaks, to rest, use the restroom, time off to attend healthcare appointments, time off to telework if possible, light duty, and also providing them with fitting safety equipment or other attire that is provided by the company to make sure that as the woman advances in her timeline with her pregnancy, that she's able to have the proper attire for her position. So who's a qualified worker? A qualified worker or applicant is anyone who can perform the functions with or without accommodation. And it's covered, you're covered if the essential functions are temporary. So if in the near future, you should be able to perform the essential duties and it can be easily accommodated, employers should be looking to do so unless the accommodation causes undue hardship. So undue hardship is an action that would be really expensive or cause significant disruption to the employer and the operations. Some penalties for not complying with the PWFA is payment of lost wages and benefits, compensatory damages, punishment to the employer, and a court order informing the employer that they need to stop violating the law, as well as the bad PR that would come with this if it gets out in the news. Since this is a new statute, there are some helpful resources here. There's a Pregnant Workers Fairness Act poster too that you can download and you can post in your places of employment if you desire. So Maryland paid family and medical leave. This is new. Karen discussed it in terms of the payroll and payroll withholdings. But I want to touch on it a little bit in terms of an employer, what your responsibilities are as an employer, and how it would interact with other benefits too. So on July 1st of next year, the contribution period begins for employers and employees. And then July 1st of 2026, employees will be able to begin collecting, applying for this through a site on the Maryland website that has yet to be established. What Family is, it's a state insurance program to support employees for up to 12 weeks who take time away to care for themselves or a family member. As Karen mentioned, it is for qualifying FMLA qualifying events. So that is what is covered. An eligible employer is any employer who pays wage to at least one person in Maryland. This does exclude the federal government, but this is wide ranging and affects many of our employers. Eligible employee is anyone who works at least 680 hours in 4 calendar quarters recorded before they need to take the leave. So if you're familiar with FMLA, you can have a rolling calendar year. 4 calendar quarters would be similar to that type of arrangement. And 680 hours equates to about a little over 13 hours a week. Does exclude seasonal contractors, but it does include seasonal and part-time employees. So they are eligible as long as they meet the hour requirements. And it doesn't depend on whether an employee lives in Maryland, only if the position is located in Maryland, which is also important. So some employer responsibilities. The employer will need to register with the family division in spring of 2025. In January 2026, you will be required to notify workers who are in Maryland about the paid family and medical leave insurance. It will, I imagine, be similar to that of the FMLA rights and responsibilities notice. And you're also required to present this to employees when a new hire starts, at least once a year. So this could be during open enrollment, anytime a worker requests paid leave, or when an employer suspects that they may need to use leave. And the benefit does provide up to 90% of the employee's wage, up to a maximum of 100% per week. I brought that point down to this slide because the weekly benefit paid is not reduced or offset to account any short-term disability policy that an employer may offer. So if you are an employer and you offer a short-term disability plan, and your employee is located in Maryland, they're also getting, say, a maximum of $1,000 per week. They could actually be double dipping based on the employer policies. And employers can allow workers to use accrued leave to make up the other 10% if they want to. As Karen mentioned, if you do have an alternate plan for family and medical leave at the benefit or greater than that Maryland is proposing, you can register that. It must be submitted to the Maryland Department of Labor for approval. How you do that has yet to be determined, but expect it should come out in 2025. And then employees who are looking to receive the benefit, they will submit an application directly to the state agency, similar to how they would request unemployment benefits. So some next steps, review the current regulations, notate the dates that Karen and I have notated here in the PowerPoint. sign up for the Maryland Department of Labor website as well as any other states in which you have employees and they may have similar leave requirements. And then there is a website specifically for the family and medical leave insurance. I would recommend as we get more information that you would look at your internal policy, short-term disability, paid parental leave, and see how they would interact with the Maryland family leave. You may want the intention to be to cover 100% of the employees' leave while they are out, but it is very likely that there could be double dipping and the employee could actually make more than what they normally do in a week. So to close this out, I wanted to kind of present to you the Crown Act, probably something that a lot of HR professionals are not familiar with or are not aware of. So wanted to kind of bring this up to your attention. The Crown Act was created in 2019 by Dove and the Crown Correlation. And it stands for creating a respectful and open world for natural hair. Like many of the laws that are in place to prevent against discrimination, this is another one in which just prohibits employers from discriminating against employment or educational opportunities because of their hair texture or a protective hairstyles. So currently there are 24 states and multiple other jurisdictions that have the Crown Act. So you'll want to make sure that you are in compliance with this as well, and that none of your policies could unintentionally violate the Crown Act. Looking at your appearance dress code policies in particular. And I have listed the site for the Crown Act, so you can become familiar with that as well. And that is it for the HR update. I want to go to Kayla to see if there's any questions. There are.
Yeah, so we have two questions.
Okay.
The first one is, are owners of the business under an exempt employee, or are they separate? And do you have descriptions of the job duty exemptions?
Yes, the Fair Labor Standards Act, actually the website lists job duty exemptions in detail, and we can make that available, Kayla. We can make the links available whenever she sends out the slides for that. And owners are exempt as long as they fall into one of the categories. Typically, they would be, as long as they're paid a salary and meet the other exemptions.
Okay. And then the second question is, could you please explain what a highly compensated employee is and what makes that person have that classification?
So there is also very detailed information on the Department of Labor's website that I can have Kayla make it available to you. I don't have it right in front of me, but do want to provide that information, and I don't want to misspeak about anything that's on there because it is very detailed.
That's it.
Okay, thank you. I'll turn it over to Sharon.
So we're going to jump into information returns and start out with 1099s. So as has always been, any person engaged in a trade or business is someone that's subject to these rules and has to abide by these for their business. You must report payments of $600 or more in any calendar year that are paid to any unincorporated entity for services for the majority of the time. That would be partnerships, includes LLCs treated specific ways, and self-employed or sole proprietorships. Examples of an incorporated entity would be your C corporation or S corporation. And those two types of entities would be generally exempt from receiving 1099s. However, there is an exception when you have legal services provided. The attorneys of the world do not get an exemption regardless of their incorporation. So they would receive a 1099 from you for any legal services that they would provide at $600 or more, regardless of incorporation. That also applies to certain medical payments, regardless of incorporation of your large medical companies. They would still receive certain types of 1099s, regardless of their incorporation, in the box for certain medical payments to them. A couple years ago, you'll remember that the 1099 NEC was established, and they pulled that box 7 off of the 1099 miscellaneous and put it onto its own form called a 1099 NEC. So you would report any non-employee compensation paid of $600 or more on the form 1099 NEC ever since that point in time. Those are also submitted with a separate 1096, and then the miscellaneous forms are their own 1096. We have a sample of the newly generated W-9 that was updated this year in March of 2024. If you remember before, we haven't had an updated Form W-9 for several years, since I think it was 2018, the last time they made any changes, but they did update that, and there's, I looked at some comparisons there. They haven't changed very much, but just a couple of things to point out on the W-9 form, which you will of course give to any of your vendors so that you can determine, first of all, that they're not needing to have backup withholding that they're aware of, and then also whether or not you'll need to issue a 1099 based on the type of entity structure that they claim they are. In box 3A, there's not a lot that changed here except for under the individual sole proprietorship checkbox, there used to be some explanation there for single member LLCs. You still would, if you were what's called a single member LLC, an LLC structure that's owned by one single person that hasn't made any elections to be treated in another fashion for tax purposes, would default to being an individual sole proprietor. In that case, if you are filling out the W-9 for that type of entity, you would choose the individual sole proprietorship box, and then you would include the owner's social security number and name on line 1 and in part 1 as well. And then you would put the business LLC name on line 2. And that's just for an LLC that's owned by one owner and has not made any other elections. And then you have this additional box 3B added here. And really the only thing to keep in mind with that new box is they're looking for some sort of tiered partnership trust structure where you may have a trust or another flow-through entity that owns an interest in a partnership. If you are filling out a W-9 and providing that to another partnership or trust estate that has an interest, and there's payments that go back and forth, and you happen to have a foreign owner somewhere up the line in the tiered partnership structure, you would check this box. Otherwise, it should not apply to you, but there's certain requirements now on partnership returns for foreign owners, and sometimes you need to know that all the way up the structure. So that's what they're trying to get at there, I would assume. Just one more quick comment. I know I say this every year, but just a reminder that if you have LLCs that you pay out vendor payments to, I would recommend that you get a new one of these W-9s each and every year. They are check the box sort of entities. Just backing up here a minute, you'll notice that the LLC, if you choose that box, you also have to add a code of so whether or not they're treated as a C corporation, S corporation, or partnership. In those cases, we can change that election at every year if they would like to. So if they are previously a sole proprietor, they could be an LLC that chooses to elect S status, and that would change their structure and how they answer these questions. Same thing goes, they could lose their S election and revert back to a partnership or a sole proprietorship. So we want to make sure that for our LLC vendors that we are getting this information on a regular basis, at least once a year, because they do have the option to change structure for tax purposes. Filing due dates for the Form 1099 miscellaneous, those are due to the IRS by January 31st of 2025 for any paper filed returns. And then you have until March 31st, 2025 to file these with the IRS if you're electronically filing. Form 1099 NECs are due to the IRS by January 31st, 2025, regardless of whether or not you're filing paper or electronically filing. And then a reminder as well that either of these forms are due to the recipients by January 31st, so you at least have to have them in the mail to your recipients by that time for either one of those forms. There is available a 30-day extension that can be requested in writing. It needs to be done on a Form 8809, and you would only be granted this though in extraordinary circumstances such as natural disasters or catastrophes. We don't see that very often, but just want to bring that to your attention. The book does include for you addresses and fax numbers to send this information into. All other types of 1099s can still be filed with the IRS by February 28th if paper filing, and March 31st if filing electronically. Just an example of a 1099 miscellaneous form, there have been no changes to this form that they've put out anytime recently. They generally issue an updated form the beginning of every year. We don't see any proposed changes to that in the draft form either. Not much to really point out here that's really new. One thing to remind everybody, the box 10 gross proceeds to attorneys, that box would not be for services to an attorney. You would use the 1099 NEC, non-employee compensation form, in order to report the fees that you paid to an attorney for services. Any other non-service related payments to an attorney for settlement proceeds and that type of thing, escrows, those payments would go in box 10. And then again, the sample of the 1099 NEC, again, really nothing changing here either. Just your non-employee compensation. This is a copy of that Form 8809, where if you do feel you qualify for any kind of information return extension for 30 days, this is the form that you would use. And then also just keep in mind that if you are in that service situation, there is a separate extension request for the recipient copy to go out 30 days late. Again, only in very rare circumstances would you have this. Electronic filing requirement, reminder that last year the IRS drastically changed the filing requirements for electronic filing. In the past, you would be able to electronically file, say if you had 250 1099 NECs, 250 1099 miscellaneous, W-2s. For each type of return, there was a filing requirement for electronically filing if you had more than 250 of those forms. drastically cut that to be an aggregate of just 10 forms. So if you were to have, say, 4 1099 miscellaneous, 4 1099 NECs, and 3 W-2s, you would be required to electronically file all of your 1099s and W-2s, really all of the information returns that you might have to file. So that was a drastic change for last filing season, and that would still apply today. They didn't make any other changes. I don't assume that they'll make it any less than that. That's pretty drastic as it was. They do offer a free portal for businesses to use through the IRS. It's actually called IRIS. It's free to register and free to use. There's a link there on the slide for you to apply for what's called a TCC number. That's something that's required in order to register for this type of portal. I would recommend that if you have a TCC number already, or if you need to get one, that you do either check the one you have as soon as possible, or get something applied for as soon as possible, because there is a 45-day wait period to obtain the TCC. And again, you need that number in order to register for the free portal. So we did have a handful of clients that ran through an issue last year where they thought they were prepared for this, had a TCC number, but it had expired, and then they didn't know it until they went to register and get set up in January, and then they were too late to get a new number in time to file on time. So there was a bit of a scrambling there. So I would highly recommend, with the lag time on obtaining that you check out that number if you have one, make sure it's still good. And then also review all the required documents before applying. There is a list of what you would need. And those documents are all included in our booklet, beginning on, let's see, which page is that on for you? I believe page 94. So page 94 in the booklet, there's the entire printout of what you would need in order to apply. Reminder that they've been changing the penalties from this for some years to try to make it a revenue raiser in some of the prior tax law bills that have passed, and that has drastically been increased over the years. Keep in mind 2025 filing season, so the one upon us, would be at a rate of $60 per 1099 filed up to 30 days late. And keep in mind that each one of these penalties that I mentioned are really duplicated, because the policy or the penalty would be applied to both what's sent to the IRS and to the individual, the recipient. They consider that two separate filings. And then so if it's 31 days late through August 1st, it'd be $130 per 1099. And then after August 1st, or not filed at all, $330, so $660 per 1099. If it's an intentional disregard, it could be up to $660 per 1099 that's not filed. And just to give you an idea, the maximum penalty involved, since that's a per 1099 penalty, for a small business, meaning your gross receipts are less than $5 million, the max penalty is $1.3 million over that. And then for businesses with gross receipts exceeding $5 million per year, that max penalty is nearly $4 million. So it can get pretty steep if you just ignore this. So it's just to say, be a little careful. Joe and I anecdotally yesterday said that we haven't really ever seen them issue these just proactively, but they do have a question on the all business returns now for several years, asking you, do you have any required 1099s? Are you required to file them? Yes or no? And then if you say yes, they ask you if you have filed them or will file them, yes or no. So we don't know when they might use that as a flag. I will say that personally, whenever I've been involved in an IRS audit, It is one of the things that they always look at on a business return. They will request copies of them and request general ledger detail of your service accounts and various things where they would expect to catch them not being filed. And they will ask questions if they see something that they think somebody should have received a 1099 and they don't see that you issued them one, they will request documentation for why. So I would think that would be the risk that you're taking, is if you don't do it, you are audited and then they ask those questions. 1099 reporting for Pennsylvania. You would report non-employee compensation and payments under an oil and gas lease amounting to $600 or more. Just a reminder about that, since we do have those types of leases pretty substantially in our Commonwealth. Use a copy of the federal 1099 miscellaneous or 1099 NEC. They don't have their own form for Pennsylvania. And then you would also use the federal form 1096. Or you would not use the federal form 1096, as it's not required. If you're filing 10 or more, just like the IRS for the federal government, you would file those electronically through MyPath for Pennsylvania. The 2024 forms, again, are due to Pennsylvania by January 31st, 2025, and we did check that includes both the 1099 miscellaneous and the 1099 NEC. So you don't get an extra pass on that for your Pennsylvania filing. So if you're doing them all by January 31st, nice to send them all in by January 31st. If you recall back several years ago, I think it might have been 2017, Act 43 was passed in Pennsylvania, and that created a non-resident withholding obligation for certain payers of PA source income and rent paid to non-resident individuals. So the withholding is required when paying $5,000 annually to a non-resident. I think Abbie might have gone over this a little bit in her section as well. That withholding, if you think you're going to be paying somebody more than $5,000 annually, that's a non-resident of Pennsylvania, but they are providing service in Pennsylvania to your business located in Pennsylvania, you may want to get this done right away, start withholding it. You would withhold these and pay them electronically via MyPath. You would use the quarterly withholding returns and annual reconciliations that you typically use for your employer withholding. You already have an employer withholding account, you use that account to report these withholdings as well. If you think that you have an exception for this, actually Rev 1834 is a form located beginning on page 209 in the booklet. That form kind of acts as the same thing as a W-9 in Pennsylvania. So I did notice, so we haven't stressed this so much in the past, but I think that I want to start stressing this and coming up with a couple of different scenarios in the past couple of years where we have employers who have locations in multiple states. I'm not sure which 1099s they need to supply to Pennsylvania. The instructions for the Rev 1834 insinuate that you should be giving this form to every one of your vendors that you give a W-9 to. If you look at the form, and I'm not sure, I think it's actually in here a couple of slides. Maybe not. It's not a copy in here, but there is a copy in your book. This form will provide to you exemptions that actually will say, okay, I'm a Pennsylvania resident, and therefore I get no withholding. So you have that box filled out and you have that on file. You're required to keep them on file for 4 years, and Pennsylvania can come to you and ask you for a copy of that to ensure that you are withholding that tax for those that are required. So I would suggest that if you haven't already been doing this, that if you're a Pennsylvania business, that you do provide a copy of the Rev 1832 along with the Form W-9 to your vendors. and have them fill out both those forms and return them to you. Maryland 1099 reporting is somewhat rare. They participate in the federal combined reporting program, so they get a copy of the federal returns already. You do not need to file with them directly unless for some reason you're required to do Maryland state withholding. You would report that withholding on the Maryland MW 508, which is again the employer withholding form in the state of Maryland. You will really typically only see this if for some reason you're required to do backup withholding for the federal, that they also have a backup withholding rule. So it kind of goes together. That's really the only time I would see a Maryland state withholding requirement. Before we get into information return compliance, Kayla, did you have any questions come through yet?
Not for me, no.
All right. And we're going to move on to just kind of keeping in mind a couple of things regarding compliance issues related to independent contractors versus employees. So there's oftentimes a question as to whether or not someone that you are reporting on a 1099 as a contractor is really an employee or vice versa. Keeping in mind that there is this form, an SS8 available that either your employee contractor or yourself can file with the IRS, and you lay out a lot of the facts and circumstances and ask them to make the determination as to whether the person is a contractor or an employee. The facts and circumstances that they look at are generally the three-prong test by the IRS, since this is an IRS form. The Department of Labor still has a six-factor test, but I'm not going to go over that in detail. It is laid out in your booklet for you, but all of those factors are covered really within the three-prong test by the IRS as well. So we'll just kind of focus on the Internal Revenue Service area. So those three areas are behavioral control. Behavioral controls are facts that show whether the business has a right to direct and control how the worker does a task for which the worker is hired, including the type and degree of when and where they do their work, what tools or equipment they use, what workers they're allowed to hire to assist them with the work or not, where they purchase their supplies for the work that you're asking them to do, and then whether or not that work needs to be performed by a specific individual. If you are doing any of these things and controlling any of those items, they may be leaning much more towards being an employee than they are a contractor. So you want to keep that in mind when you're dealing with your contractors. How much control are you having over what they do, and how much training do you give to them? The second area we're looking at is financial control. Again, that's to the extent that you reimburse a worker for their business expenses. So if you are reimbursing this person for their business expenses that are out of pocket under some sort of an accountable plan that Joe talked about earlier today, in that case, they're much more like an employee under the IRS's viewpoint. However, if you're not reimbursing them for their business expenses, then that leans them more towards being a contractor. The third area of that we're looking at is a type of relationship. Do you have a written contract with them stating that they're a contractor with you? Do you offer them certain benefits like you would your employees? Like if you offer them things such as insurance, a pension plan, vacation pay, sick pay, those types of things, they may lean much more towards the IRS classifying them as an employee. I would think this would be a pretty strong argument for the IRS in that case. And then the permanency of the relationship, how long does that person work with you? Or, Is it short-term, long-term, those types of things. So just some things to keep in mind, because there is this, if you're unsure as the employer, you have the right to file the SS8 and ask the IRS to give you the answer. Your contractor or employee, though, your contractor may think that they're an employee and should be getting some more benefits and not have to pay self-employment taxes. So they also have the right to send in a form SS8 and ask the IRS to disagree with the way that you are classifying them. So some things to keep in mind there. And then if the IRS were to overturn your classification and then you have a bunch of payroll taxes to consider, something to keep in mind before you get to that point. Backup withholding, just again, I mentioned this a little bit earlier, but backup withholding is held at the rate of 24%. So in cases where you would need to report that, if you issue a W-9 and someone refuses to give you the signed W-9 back, they are then telling you that you have to withhold 24% in federal taxes and report that into the IRS on the form 945, which I believe Abbie went over a little earlier in the webinar as well. You would get that into the IRS, and then of course, if you're a Maryland employer, you would also be subject to backup withholding from Maryland under that situation. Just mentioning the B notice, those are the notices that you may or may not get after you file your 1099s. So the IRS says, hey, we don't match up the same social security number with the name that you have on this W-2, or not W-2, 1099. And then you're required to go through and make sure, verify that that is correct, and then correct it in the future. We already went over the form W-9. Before we go into beneficial ownership information, any questions? Good. No more questions for that area. So we'll just head right into beneficial ownership information reporting. This is something that's new. We kind of touched on it last year, and it was originally something we thought you might need to do before January 1st of 2024 at that time. They did end up extending that. There's still a couple of court cases kind of lingering out there, but nothing's been overruled, and this is kind of full ahead at this time. Under the Corporate Transparency Act, we are now required to report beneficial ownership information to the Financial Crimes Unit of the IRS. Those reports must be filed by January 1st, 2025 for any entities that were existing as of 1/1/2024. If you had an entity created after that, after December 31st of 23, then those were to be filed within 30 days of the date that they were created with the state that you're located in. So if you have something like that happen, you might want to make sure that you get those filed as soon as possible because they may be already late. Changes or inaccuracies filed with your original report must be done within 30 days. So just a reminder that this is not an annual filing that you need to do. You need to do it one time, but then if there are any changes of addresses, new driver's licenses issued, those sorts of things, those changes would need to be filed within 30 days of your notification of those items. There are several exemptions, though, to consider for this. One that we see probably more often than not are the large operating entities. Those would be entities that have more than 20 U.S. employees and gross revenues over $5 million on their prior year's tax return, and they have a physical office within the U.S. So that's one of the most common exemptions that we're seeing. Also exempt would be publicly traded companies that are registered under SOX. And then other exemptions, there's a total of 23 that are located on the FinCEN's website, include governmental entities, banks, tax exempt organizations, insurance companies, for example. So those are just a few. Like I said, there are 23 of those. We do have a full list linked to those on our website, and we did recently sent out some checklists that are available to for you to document whether or not you meet any of the exemptions. If you do need an exemption, I would recommend that you get a hold of the actual checklist, which goes into a little bit more detail for each of the exemptions. Get that filled out. There's a checklist, an actual checklist on the website, and get those filled out and document that and keep it on file. If you do not need an exemption and you do need to file, information that you'll need to file that return will be the full legal name of the reporting company, including the trade or DBA, the business address, the state of formation or registration, and that would just be the original state, not if you're doing business in multiple states, but wherever you're originally filed. Your tax ID, and then the beneficial ownership information. And a beneficial owner in this case would be anybody that owns at least 25% of the ownership in the entity. And then anyone who has substantial control within the entity. And there's a list of what creates substantial control, and that could be like your executive officers in most cases, who may have that less than the 25% ownership, but they're like the president of the company and they have substantial control in that case. There are some exemptions for people who are just employees and happen to be the CEO, but they don't have any ownership, and it's at the will of the owners to change their position. Those people would not be considered beneficial owners. There's some exemptions there as well. Also, if they happen to be a minor child that owns the percentage, those are also exempt. There's some information on here on who the company applicant is. That would be the individual who files the document. So when you get into the website and into the portal and into the filing, the person who's doing that would enter their information, and then they're primarily the responsible person for controlling the filing of the document. The reason we're bringing this to everybody's attention, there are substantial penalties potentially for non-filing, up to $500 per day in civil penalties, to $10,000 in a criminal fine, as well as up to 2 years of imprisonment. So we want to make sure people are aware of this. We at Brown Plus have been advised by our professional liability insurance company that we can't actually do this filing for you. However, we are hoping that most of you would find that it's a fairly simple process for a lot of people to go on. It's free to file online and give this information. One of the other items that you'll need for all your beneficial owners, which might be the one painful area, is that you need a copy of the driver's licenses for each of your beneficial owners, and that needs to be uploaded into the portal for FinCEN. So just a new topic that is coming quickly due. Before we know it, it'll be here. Then one more topic that we just want to touch on. We've been talking about this for a couple of years now. It's still a little bit lingering out there. The employee retention credit, just about done and over with, but that was a COVID era credit available. The last filing statute of limitations is for tax years 2021, 4/15, so April 15th of 2025 is the final deadline for trying to apply for any of those credits. You will remember that last year the IRS halted the processing of those claims and had a moratorium on that. Just beginning this month, they have told us that they are now expected to resume. And I will anecdotally say that I received notice from one of my clients who've been kind of hanging out and caught up in that moratorium. Just this past week, received their first quarterly refund.
And we had somebody else who's starting to receive notices for anything that they want additional information for. So it does appear that they have started that back up again. So we're seeing a little bit of progress on that end. So that's all I had for that. Joe, did you have anything to add on that?
No, I think you covered what was relevant with respect to.
Renee, any questions?
We have just one right now.
All right.
If you have an exemption for the DOI, does it hurt to file anyway, or is that not recommended?
I would say it's hurt. I don't think there's any penalties out there. It's just whether or not you want to give them your information. I think that's the big thing. But as far as we know, there's nothing out there that says you can't do it if you do have an exemption.
That was the only question.
All right.
All right, well, thank you all so much for calling in for our year-end seminar today. Be on the lookout for an email from me, Kayla Juba, with the materials and reporting early next week. Have a great rest of your afternoon.